Good afternoon, everybody. Well, first of all, congratulations to all of you for making it to the end of this terrific day. First off is good job, and thank you for being here with us this afternoon. I think you're really going to find this to be an incredible panel. My name is Ana Alvarez Boyd, and I am the Senior Associate Director in the Division of Community Consumer Affairs at the Board of Governors. And that means I have one of the most incredible community development teams in the country that I get to work with on a day-to-day basis. I also get to look out across the community development field and think about innovation and think about the problems that we're facing. We also have a research unit that looks at consumer and community development issues that are and they're very much focused on producing original research and surveys. So we're doing surveys on the household financial decision making, on young workers between 18 and 30. You're going to continue to see very interesting things coming out of our shop. One of the most important roles that we play, though, is keeping an eye on emerging trends and issues, funding the initiatives and projects that we've been discussing over the past few days has always been a challenge. But in the aftermath of the financial crisis, that challenge is more greater than ever. And I think you've heard that in several of the panels and the discussions that you've had with folks here today. As I've been running into people from nonprofits, I've been asking, how's funding going? And every single time I get the, it's much tougher than it used to be. Philanthropy has realigned their priorities. There's fewer banks that are focused on their CRA responsibilities. We've had a lot of mergers over the last decade. Sources of government subsidies and reimbursements are eroding and they may not recover. So the needs are greater, and we're now starting to think about community development as an integrated set of systems that leverage each other. So we're thinking about this in a bigger way. We're thinking about the needs in a bigger way. We're starting to think that housing isn't enough. You can't just build housing. You also have to think about the health care that comes into a community. Where are the social service agencies, the job opportunities? And as we heard from the lunch speaker today, if we don't get education right, nothing may be enough for what we're doing. So there's a pressing need for innovation, a real critical need for innovation right now. I think everybody feels it. It's on the lips of everyone you talk to. So I want to tell you a little bit about my introduction to crowdfunding, which is one of the innovations that you see developing these days. I had a former intern from a former job call me and say, I'm going to send you this email. And I was like, really? Okay, that's interesting. What are you looking for? He sent me an email that basically crowdsourced his down payment on his home. And I had one of those moments where policy and practice and everything sort of comes together. He had crushing student debt. He'd just gotten married. He was trying to buy a foreclosed home in Atlanta, and he's a high school history teacher. I thought, this is where policy and practice and everything that I'm working on comes together in one moment. So at the board, we started to look at crowdsourcing and crowdfunding a little bit closer. We partnered with some of our system colleagues. And we started to think about crowdfunding in a new way. What is it? What does it serve? Can it serve a need? Can it fill a gap here that so many of us are trying to think about filling? It serves as an alternative source of capital to support a wide range of ideas and ventures by having small contributions from a large number of people. We were chatting earlier with the panelists. Some of them didn't know that we were even in DC, where there's a platform that funds real estate development. So you and your neighborhood could own a part of the local business or a business, a restaurant. It's called Fundrise. It's an interesting platform that's starting to develop all over the country as a source of getting to bigger kinds of investments, bigger kinds of deals. The exact data on the size of crowdfunding market is vague, But reports suggest that crowdfunding platforms have raised about $2.5 billion, funding more than 1 million different kinds of companies across the country. To get us just all on the same page, what is it? It's not just a solicitation from a former intern for a down payment on a house. That's one form. That's donation-based crowdfunding, where the member of the crowd expects absolutely nothing in return. Reward-based crowdfunding is where you have an item or a privilege or an accolade that comes in return, something like tickets to their first showing of their movie. Debt-based crowdfunding, where the member gets his investment back, but perhaps nothing else, no interest. And then a new form that's developing, security-based crowdfunding, which a member owns a portion of the company. And that's where you start to see some real estate investment and that type of thing coming together. It's an exciting, evolving environment. It's full of potential. Crowdfunding is one of the aspects that you'll hear about in this panel. But I raise it because it's the example of innovation that's being fueled by technology, by a drive toward collaboration, and a need to fill the incredible needs that we have in our industry right now. So I'm going to give the time mostly to the panelists here and turn this over to Kauser. But I do ask you to think about your evaluations. This has been just a fantastic conference. I give, again, hats off to Teresa and her team and our colleagues in the system that brought this together.
Thank you.
Kauser?
So, thank you, Anna, for that wonderful introduction. Hello, everyone. I'm Kauser. I'm the moderator for this session. And as I was looking over the agenda, and I'm looking at all the topics, you have heard about problems, you've heard about needs, you've heard about ideas, we've been inspired at lunch. And this is the session about money, okay? Where is it, how much is it, and how can I get my hands on it? Now, it's true I work with the Federal Reserve, but I am not here to write a check. So let's just get that off the table. However, you know that adage about teaching people how to fish rather than giving them fish. And that's what we're going to do today. We're going fishing. And for that, we have a great set of panelists who are experts in their area. And they're each going to talk about a specific type of a solution. And when I was thinking about this session, I thought, what would I want to hear from this session if I was sitting down there rather than up here? And so I had 3 questions that I am using to structure our conversation. My first question is, who are these people and what are they talking about, right? So we're going to talk a little bit about the kind of solutions they're talking about. The second question is, how is it relevant for me and how is it relevant for me? And then the third part of it is that if I like what I'm hearing, if it answers some of my needs, how do I get more information and how could I use it and adapt it for my needs satisfactorily? So with that in mind, we're going to have a conversation in 3 parts. The first part, we're going to go with each of the panelists and they're going to talk a little bit about what kind of a need the ideas they're talking about solve. Who is it really good for and who does it not work for? Then we're going to roll up our sleeves figuratively, and then we're going to talk about the how-to. How do I access this? How might I adapt it for my personal needs, and so on. Then we'll come to the third part, which is where you all enter into the conversation. We're going to have a Q&A, and I would like you all to go up to the microphone and have your question ready, keep it brief, so we can get a lot of the conversation in, and that's where we'll be able to really take these ideas and customize them to the ideas and needs that you may have, okay? So with that plan in mind, let's get started. So I'm going to start, well, you have bios of everybody, right? So I'm just going to ask our panelists to say a little bit about themselves just for a second, and then we're going to jump right into it. And the order is going to be Mark, Steve, and Liezl, okay? Mark, you're on.
Thank you. It's good to be here with everybody in my hometown of Philadelphia. So it's great. And thank you for the introduction and the framing. I am Mark Pinsky. I am president and CEO of a company called Opportunity Finance Network, which is a national network of community development financial institutions, which are private sector financial intermediaries that provide financing that benefits low-income, low-wealth, and other disadvantaged people and communities. That's the broad purview of what we do. That takes the form in all 50 states in urban, rural, and native communities. Takes the form form of financing, we're back on, financing for affordable housing, both multifamily and single family, for small businesses, for nonprofit businesses, commercial real estate, and whatever else those opportunities might come up. And that's what we do. Just to give you some idea of scale of what we do around the country, there are, depending on who you believe, somewhere between 700 and 800 CDFIs working. They managed, again, depending on who you believe, somewhere between $40 and $50 billion of capital. They try to provide capital that is flexible and long-term and fit to the customer, and generally on concessionary rates or provided in concessionary structures. So a little bit about that. Do you want me to go on a little bit?
Yeah.
Okay.
Yeah.
So let me talk, because this panel has given us a chance to all think about innovation, and I'm sitting with two great innovators and great examples of what's possible when you think new ideas and then prove that you can execute it. So I'm eager to hear them. But when I really thought about this, I thought first I thought that the innovation that CDFIs represent, and we've been doing this for 30 some years, and we used to be hip and cool the way Kiva is, but we're not anymore. But in fact, we're still innovating, and the innovation is really building a kind of institution that has the agility to respond to rapidly changing and slowly changing market conditions. So to go from one day being affordable housing funders or financiers to financing small business, or to financing community businesses or charter schools or anything like that. And an example of that, just really quickly, I remember in 1996, I was at an American Bankers Association Community Development Lending Conference, and all the bankers were saying, well, geez, everything's great right now except for these CDFIs, because here we are, we're lending to them and we're supporting them, and then they're competing with us for all our business. And that's not right. And then I went to my conference with CDFIs, and they said the same thing from the other side, which is everything's great except these banks, because they lend to us and they support us, and then they come in and they compete with us, right? And it was really a case, it was a big aha moment for our entire industry, which was a lot smaller then, because I think it was this realization that when you're working in a marketplace, sometimes the margins move. And if what we're trying to do, and we are trying to do as CDFIs, is provide financing sort of just outside the margins of where conventional financial institutions or conventional government or other public or private structures can go, we better be ready to move when the margins move, and we need to be able to do that. And that, for many years, meant that we had to get out of the way, because mainstream financial institutions and others were willing to move into markets where they hadn't gone before, and financing, if we can, or we try and find that happen. And so the last thought I'll offer, and then I'll try and keep within my time here, is that what I really thought about was that innovation in this space is probably innovation of intermediation, rather than product or other things, and there are products attached to that. But it's real, Walter Wriston, who used to be chairman of Citibank many years ago, said that, money goes where it's wanted and stays where it's well treated. And the challenge is figuring out, in these markets that are maybe not usual or conforming or standard, how do you make that work? How do you make the money fit and be well treated? And then how do you pay back your investors? And that's something we've gotten pretty good at. So
uncovering the opportunities that have not been exposed yet or brought to light.
Absolutely, yeah, I think that's right, and I think that's the story. That's why we're opportunity finance, right? That was one of the big ahas too. Was that there are opportunities everywhere, and sometimes they're just not visible, and sometimes there are opportunities because we still have this problem with discrimination in lending in some places, believe it or not, and sometimes it's just not an understanding that you can lend in a low-income or low-wealth community and make a business work, for example. And so we have that experience, because we're in the communities and we know the folks in the communities, we know the businesses, we know the homeowners, we know the developers, and that's how we make it work. Right?
So we'll come back to you.
Yeah, thanks.
So Steve, why don't you start off with what's the gap that the trust is meeting, and then take a little bit of time to describe the trust so people can understand what's going on there.
Hi over there in that corner of the room, because you're not going to see me again, I guess. So basically, the trust was created by ordinance and executive order. So executive order of the mayor of Chicago, whose idea of the trust was, and then an ordinance by the city council of Chicago. And in terms of the gap that they were contemplating the trust would fulfill, is basically an alternative financing methodology. So the city of Chicago, like most municipalities, essentially funds their activities utilizing bonds of one kind or another, and that's it. bonds, bonds, bonds. That's the only way that they finance things generally through whatever their activities are, unless there's a direct revenue activity that they're doing. So it was decided that there needed to be a mechanism for doing alternative financing for infrastructure projects. And the trust was created for the purpose of creating a methodology to essentially do private placement of infrastructure projects instead of having to promulgate a bond to do an infrastructure project. And that's the gap that the trust is trying to fulfill. So the trust was created to a lot of fanfare. There was a gap in its activities. Eventually staff was hired. I was the first person hired, and I'm the CEO. And essentially we went about trying to figure out how to do alternative, innovative financing, privately placing projects for the city through the trust. The projects that we do, not to scare anybody, because I've been told it could be scary to talk about various accounting issues, but they're off balance sheet and off credit for the city. So the trust acts as an intermediary to provide that accounting ability. And interestingly, at this point in 14 months, the trust has almost $1.5 billion of projects that we're working on. So as a concept, the trust concept actually works. When I took this job, I wasn't sure whether or not the concept would work, but it clearly works. We have a significant number of projects that we're working on at the moment. And there are some interesting things that have come about as a result of the creation of the trust in Chicago, one of which is that we have the ability to span multiple units of government. So in Chicago, there's 16 units of government that essentially run the city. The mayor may be responsible for appointing the head of that unit of government, like the Chicago Transit Authority. The mayor appoints the head of it, but it's got its own board, it's got its own bonding capability, it's got its own bureaucracy. So the thing that the trust is able to do is to actually do a project that may involve the CTA and 3 other agencies in the city, and to essentially fund that project with all of the agencies. So we're doing a streetlight project right now, and we're putting wireless carriers on the streetlights, which involves 2 different agencies in the city of Chicago government. And then there are a lot of other things that are going on with those streetlights that involve other agencies in the city of Chicago government. So we've been able to actually span multiple government units within the city of Chicago as we do our projects. We're pretty basic. We're an infrastructure project delivery and finance company, and we do what you would expect to do every time somebody is delivering an infrastructure project, except we use an alternative financing mechanism in order to deliver that project.
So before we move on, could you just say a little bit about, does this give you, what's the benefit of this versus the more traditional ways it could have been done? Do you get better pricing? Do you get capacity? Is there scale issues here? Just amplify a little bit on the real benefits of doing it this way.
There are a number of benefits, and then there are some things that I think will be benefits, but there is a lot of education that has to occur. So one thing that happens with municipal officials, and I come out of the private equity world, so municipal finance is new to me. But one thing that happens with municipal officials is they tend to compare everything to a bond. And when they look at cost of capital, they tend to look at the cost of capital of a bond as opposed to of a total project. And the cost of capital for a total project is actually different than the cost of capital for just a bond. So there's no sort of value engineering component to the bond. When you're looking at an overall project, there's a lot of other components. And so I think that's been extremely valuable in that we get to the true cost of capital of a project as a result of the work we're doing. My favorite thing is that as a private company, we actually have 3 procurement methodologies. We have the traditional RFI, RFQ, RFP type of process that many of you are probably aware of, but we have 2 other processes which are more common to me coming from the private sector, one of which is an unsolicited proposal process and the other is a collaborative bid process. So our unsolicited proposal right now, we're doing a project to renovate the 141 pools in the city of Chicago, which are run by the schools and the parks. And I swim, and I've been in pools, but I never really took a look in the mechanical room. And it turns out that there's a lot of stuff that runs pools, and that constantly needs to be upgraded. So it would have never occurred to me in a million years that there was a big project to do with pools, but there was a company that was renovating YMCA pools around the country, 1 or 2 pools at a time. And because we had an unsolicited proposal mechanism, they came in and they said, we're interested in renovating all the pools in the city of Chicago. We said, make a proposal. They did. And that caused us to then go to an open bid process where we solicited other proposals for anybody who cared to submit one. We wound up with 3 major multinationals submitting proposals, and we're now in the process of selecting the winner. But that's potentially a $50 to $100 million project. It would have never occurred to me in a million years. When the project was proposed, the mayor of Chicago got directly involved to ensure that everybody participated appropriately. He was excited about it, and the project is coming to fruition. So we have over $1 billion of proposals like that that are unsolicited, that we did not start with an RFP. So that's been a very exciting proposal. We are in discussions for some collaborative proposals. A collaborative proposal being that if a company wants to come in and spend a lot of time and money up front to do a project, that essentially we can enter into a contract with them given the fact that that company will invest that time and money, as opposed to them being worried that we're going to pull the rug out from under them at the last minute and not give them a contract after they've made millions of dollars of investment, which is a frequent worry in municipal and state markets. So we have this collaborative proposal, and we're considering several bids under that right now. I suspect that they will be larger projects in and of themselves. They'll be billion-dollar projects where the investment is great and where the companies don't want to spend the time or effort or money without having some sort of assurance.
Great. So we'll come back and explore these some more. Liezl, you're on.
So my name is Liezl Van Riper, and I'm with Kiva. And Kiva is a technology platform that enables anyone to make a loan for as little as $5 to an entrepreneur around the world. How many of you have heard of Kiva? Great. How many of you have made a loan on Kiva? Thank you for that. So this technology platform is about 8 years old, and we've raised over $550 million in loan volume from 1 million lenders who have lent small little microloans to over 1 million borrowers around the world. So this is truly a global platform, and it's a global movement. And we realized in 2009 that we could take the Kiva model to the United States and see if we can start providing a way for financially excluded entrepreneurs and borrowers right here in the US to crowdfund loans to launch and grow their businesses. So I think right there, it's important to point out what Kiva sees as the problem statement in the United States. There's 25 million micro enterprises in the United States today. And in 2012, there were only 25,000 microloans that were made in the entire country. So 25,000 loans to a potential of 25 million micro enterprises. And it's really hard work to try to qualify these borrowers for loans in the United States. What we find at Kiva is that for every 7 out of 10 small businesses that are applying for a loan are getting rejected every day. And it's not to say that banks are evil and small businesses are the hero. It's businesses have to, banks have to, underwrite these loans, and they have to look at the financial health and financial data of a potential borrower. And there's an information gap because a lot of these micro enterprises in the United States simply don't have financial data to present to a bank. So they're not able to qualify for these traditional loans. And microfinance institutions as well, they have their underwriting criteria. And oftentimes, lots of these entrepreneurs around the US, they're just not able to qualify for microfinance institution loans as well. So what we're doing at Kiva is we're trying to figure out a way to address the problem. And what we're doing is, instead of assessing a potential borrower's financial capital as we underwrite a loan, how about if we could base their creditworthiness on their social capital? And so what do I mean by social capital? I mean, can you base a borrower's ability to repay not on whether they have the right credit score or the right debt-to-income ratio or the right collateral, but maybe because they have character and they have a really sound business model that somebody is vouching for. And so that's social capital. The idea that you have the right character, you have the right hustle, you have that entrepreneurial hustle, you really have what it takes to start or grow your business, but you don't have the traditional financial capital that banks and microfinance institutions are looking for when they're going to underwrite and qualify you for a loan. So that's really what Kiva is introducing here in the United States. The idea that with social capital, we might be able to dramatically increase the number of small businesses and micro enterprises that could qualify for lending. And if we can drive down the cost of actually acquiring those borrowers, then we might have a model that could really take off. And what do I mean by driving down the cost? I mean technology. So right now, microfinance institutions, they have a really formidable task of having to go out into the communities and look for borrowers to qualify for those loans who are typically in low-income neighborhoods who need local language brochures, materials that are going to be able to speak to them. And all of that costs money. And it takes quite a bit of hard work on the microfinance institution's part to actually acquire that borrower. But if we use technology and leverage technology in a way that can acquire borrowers without actually having to go out and underwrite these loans and go through maybe a shoebox full of receipts and create a balance statement based on that, then we might be able to come up with a model that's scalable. So if we can combine social capital as our new underwriting tool and technology and bring those together, we might be able to scale a model that can increase access to capital to many, many, many more American entrepreneurs. So with that, I think I'll actually walk you through very quickly an example of what I mean. So this is Victor. Victor is in San Francisco, and he emigrated to the United States at the age of 11 and spent much of his adult life working in cafes and restaurants. And he had a dream of opening his own cafe one day in the Bay Area. So Victor went through the Mission Economic Development Agency's entrepreneurial course. This is an entrepreneurial course geared toward Latino entrepreneurs. And the instructor for his course recognized that Victor had a sort of that entrepreneurial hustle. He had a gleam in his eye, and he knew that Victor was going to probably be really successful if he had the capital to open up his cafe. But Victor applied for a number of loans from CDFIs, MFIs, and banks, and he just didn't have the financial capital in order to qualify for a loan. So Victor's instructor at the Mission Economic Development Agency told him about this new program at Kiva and endorsed him and basically told Victor, I will vouch for you because I believe that you're going to be successful and you'll repay back your loan. So the Mission Economic Development Agency applied with Victor and publicly endorsed Victor to crowdfund a $5,000 loan on Kiva. It's 0% interest. And so 67 lenders from the internet all put in about $25 each. And on this website, you can actually interact with the borrower you're supporting. So there's this wonderful communication channel, sort of like a Facebook wall. So you could cheer on the entrepreneur and say, hey, Victor, great job. I hope you make your goal. Hey, Victor, I can't wait to check out your coffee shop as soon as you open it. So this communication channel actually opens up the opportunity for new customers and new brand ambassadors. People who are supporting Victor are going to share that loan they made on their own social media channels. So this is much more than simply a check. It's not just a loan. It's a new community that's really rallying behind you and saying, I believe in you. So Victor, with his 67 lenders, opened up his coffee shop, and he repaid back his $5,000 loan at 0% interest over 12 months. So that qualified Victor for a second $10,000 loan that he could repay back in 24 months, also 0%. But the cool part is now Victor, like the Mission Economic Development Agency, can now be a trustee. So he endorsed his friend, Rocio. And Rocio is a housekeeper who was using the public transportation to travel around on the buses with her vacuum. She crowdfunded a $3,000 loan on Kiva. She bought a car, and now she's become a trustee to Ava. So this is the scalability potential of this, and it's very cost effective.
Teresa, am I missing something? Oh, my microphone?
Oh, my microphone is off.
Oh,
I can hear you fine. I don't know.
exactly. Right. I got a little bit too enthusiastic with all these great comments that were happening here. So while they're getting me audible again, I wanted to come back, Mark, to you, because you've put these two very interesting innovations.
Yeah.
Private placement, which is kind of like getting the bigger players, because private placement cannot be done with people like me. And you're sort of mobilizing the village to come together and build things. So Mark, you talked a little bit about the margins moving back and forth. And I think that's exactly what the situation is. You know, it broadens and it narrows, and intermediation needs to follow that and maybe slow. Talk a little bit about where you think the margins are going and how you see these two innovations fitting into that.
Where I think the margins are going. Well, geez, I'm in the room with the Federal Reserve, so the Federal Reserve tells us where the margins are going. At least I thought. So I think a few things about this that I think are relevant. One is to Steve's, what Steve's doing is, you know, it's clear that municipal governments in this country need to find new ways of getting things done. And it's not just about how do you raise the capital, because, you know, other than those that go bankrupt, you know, a lot of municipalities can still, you know, float bonds and do all that sort of stuff. But it's really about how do you have the ability to be creative in how you find solutions to do things. And I think that that's something that's harder for governments to do when resources contract. So, I mean, I think that that's that's one interesting perspective. I actually really want to focus, though, on the small business space, because I think that what's going on in this country in small business is, I think there are some great entrepreneurs. There are more entrepreneurs than ever many of whom, unfortunately, may have lost jobs during the recession and decided to set out on their own, or have always had a dream or are trying to grow a business. But in our business, we actually saw something starting in about late 2009, early 2010, where we started hearing from the formerly banked businesses. And those businesses, some of whom had been in business for 10 or 15 or 20 years, and they may have been a retail business that, for example, relied on a seasonal line of credit for inventory, right? And they walk into the bank one day and that product wasn't available anymore. And so they were suddenly coming to CDFIs. We hadn't seen these people before. And saying, you know, can you lend me money? I'm desperate, right? And what I want to focus on is not just what happened then, but it's that sense of what happens when small business credit becomes less available, right? It becomes scarcer. And one of the things that happened along the way as well was that the Small Business Administration changed its policies, doubled the loan size that it would approve under its 7A program, which is a prime driver, it's a guarantee program, it's a prime driver of small business credit. And so loans tended to get bigger. And so small businesses got left out. And that was generally true. African-American business from 2007 to 2012, African-American-owned businesses accessing the 7A program went down to 82%. It was a sort of a shocking drop in some ways, right? So bring us to today and where I think the margins are going. Small businesses in this country, those that have been able to weather the recession or those that started up, those maybe some of the folks who've been able to get starts because of Kiva, those who've been able to benefit because of infrastructure projects in Chicago that created opportunities around them, right, the secondary businesses, they are really desperate for credit. And there is, in my opinion, there is a rise in unscrupulous and in some cases predatory small business lenders that are coming into play that I am really worried about. So the small business space is a space from the CDFI perspective. We are really focused on how do we scale up or how do we improve what we're doing to provide more credit into that space, and how do we do it quickly? Because as in what happened in the mortgage business, the challenge isn't just to be there with credit, it's to be there before the other people are there. And frankly, they can get there really quick, and they're really good at that marketing and reaching into into the, frankly, the pockets of some of those small business owners. And so, there are lots of things. We think that we think the economy is slowly getting better, just like the Fed thinks it's getting better. The Fed's getting better too. Where we're really focused right now is trying to figure out on how to get CDFIs doing more small business lending, because we don't think this is a short-term thing. We think this is a sort of a structural and a systemic problem. So we think over the next 10 years, CDFIs have to figure out how to be providing a significantly greater volume of small business credit. So I don't know if that's what you're asking, but that's what that's the margin I'm focused on.
Yeah. So there is this sort of this. If you think about it as a spectrum, it used to be that the traditional lenders provided funding for a larger variety on that spectrum, and because of efficiencies and a whole bunch of different factors, that spectrum is getting more fragmented. And that's where I think about it. And you're talking about the really small, possibly higher risk, certainly a new company, and how to do that. But even if they're not high risk, they just have demands for small loans. Which is what you're talking about.
Yeah, well, no, I would say $1 million and under small loans. I mean, so bigger than that, and repeat lenders, and I mean, the small business credit is not out there. And I'll wade further into a place I probably shouldn't go in this room, but one of the things that's happening is there are a lot of pressures on the banking business in this country, who have traditionally been the main source of small business lending through 7A. And I won't go into great detail, but it's hard for banks have a lot of pressure on earnings. And on margin, and the regulators are breathing down the Fed. But really, what's happening is it's a lot. If it costs the same to do a $5 million loan as a $500,000 loan, they're going to want to do the $5 million loan. I mean, that's its basic economics of the business. But for a whole bunch of reasons, smaller businesses, and not just those that you're helping to get started, but as they get significantly bigger, are really getting squeezed and potentially hurt in the small business space. So that's an area for us that's a margin that we're trying to keep up with.
So we're going to talk a little bit about the phase two. Like, I hope you're all hearing things that you find interesting, and that you're thinking about the questions that you want to take this discussion to the next level. But I guess my question to both Steve and Liezl is, who is this not good for? Steve, you're really in the infrastructure space, right? And we're talking about fairly substantial kind of financing here. Tell me a little bit more about who this is really good for in the audience, and where would it not play well. And let's get out of Chicago and think about other geographies or other applications.
Well, as you all know, Chicago is the third largest city in the country. And the trust, which is not that old at this point, does appear to work there. And we have significant interest from corporations wanting to do projects in the city. And there's significant volume in the city to interest the corporations. So having said that, I believe that the trust concept scales in some fashion or another to other municipalities that are not as big as Chicago, and to states and counties and other types of unit of government. They may not have as many projects as we can do continuously, but there may be in certain units of government 1 or 2 projects, and when you've done those, you're done. But there may be other units of government where they will never run out of projects either. For example, most state governments actually have a lot of infrastructure, despite a state being populous or a state being rural. So I think that what we've done conceptually should work in any jurisdiction. I think the volume and size of projects will change.
So say a little bit about the amount of seed money that was used to set you up, and what others might need to get something like that going, and how large a staff or what kind of resource needs do you have to make it go forward?
So the first thing I should say is that basically the thing that I am concerned about the most from my perspective, being the trust in Chicago, is cash flow. Because as we started out with smaller projects, and now we're graduating to bigger projects. And it takes a while for a project to cash flow. And the trust has to be self-sustaining. So we are a 501c3, but we are a business, and we have to be self-sustaining. So basically, I'm trying to do bigger and bigger projects because project development cost is basically fixed. Whether I do a $10 million project or a $1 billion project, I pay about the same amount for project development. But the revenue from that project moves depending upon the size of the project. So I'm trying to do larger projects now, and we will continue to do smaller projects that are in the public good that may not provide much of a return, but we have to make sure we're managing so that the trust can be self-sustaining. I have a staff of 4 people, and we're managing $1.5 billion in projects at the moment, and actually have a pipeline of probably a similar amount for projects that are not far enough along yet for me to put a monetary number against. So it doesn't require a lot of folks in order to do it. They do have to be competent. I like to think I'm competent. I know that the people I'm working with are competent. Do you know me? So anyway, and the city of Chicago gave us seed money for they gave us $2.5 million seed capital. That number was probably more of a political number than a project-based number, meaning that they didn't do any sort of fantastic analyses in advance to figure out how much money we would actually need. And we need more money than the seed capital that was provided in order to really get off the ground over time here. But I think we will be able to generate that capital as a result of operations. And so I think that ultimately you can start off smaller and have a much smaller capital need. And basically you can start off with one salary and have a very low capital need. And the projects that we do, frequently the savings pays for the project. So the projects that we're doing at the moment cost the city of Chicago nothing, zero. So the financings that we're doing at the moment, the savings is paying for the financing. So that's a very, very important point, because if you don't have, an allowance that you can spend on stuff, then you need to have projects that basically generate a return on investment to allow you to pay for the financing. And all the projects that we're doing at the trust at the moment basically have a return on investment, and the savings pay for the financing. So that's critical.
So is there, I can usually only hold one number in my head at a time. So is there like a sweet spot number I should think about in terms of a project that's like, don't go below this, it's not economical?
Well, again, I think that will float with the size of the entity that is doing the projects. For me, that number is about $100 million. So, but if you were in a rural environment or you were in a small town, that number might be $5 million depending upon how you're doing your projects and what your framework is. Right. But in the city of Chicago, right, it's $100 million.
$100 million, yeah.
To sort of run a slightly better than break-even project.
Right.
From an expense standpoint.
Yes.
From the city's perspective, it may be a great project, but from a self-sustaining corporation perspective, it may be challenging.
So if I think about the class of projects available in Chicago, is there like a certain amount that are really adapted to this use and the others have to go and find different ways of being funded to be addressed?
It's all based on return on investment. Mm-hmm. So essentially, I think one of the things that we've done in Chicago at the Trust is we're extremely analytical. So I haven't met anybody in our municipal government that's as analytical as we are at the Trust. And I think that was something that was probably lacking as they were attempting to get financing for various projects before we came on the scene. But basically, we're extremely analytical, and I think that that's extremely important because we're trying to determine return on investment. And essentially, you've just got to have return on investment, and that's depending upon size is a function of scale. So if you're in a smaller environment, you're going to have smaller projects, and you'll have a smaller return on investment, and so you're going to have a smaller staff and so on. I think that in some environments, it may not make, if you're not worried about off credit, off balance sheet, it may not make sense to have a separate organization. You could just have somebody in your governmental unit who is doing this type of work. It will be on balance sheet, on credit as a result, but because you need that third party entity to have the off balance sheet, off credit ability. But essentially, you could just have a person in a unit of government who's doing this work. You won't have the overhead that's needed. And so you could have a much smaller project that's still providing adequate returns, because then you would only be worried about the self-financing of the project.
So I'm assuming, I'm hoping there'll be more questions probing Steve a little bit further about this if you're interested and about the financing. But that's really the twist or the angle here.
Yeah, I want to go out and get on the website for Kiva. I mean, I was like, kind of, okay.
So I'm going to ask Kiva's. So Kiva can mobilize the world, right, to help everybody else. Is there a capacity constraint, or do you see this as without capacity? Then what happens to the Marks of the world and the CDFIs?
Great question. So we could potentially onboard many more borrowers, many more entrepreneurs, especially here in the United States. But we have to manage that with our demand by the lenders. So a big part of what we do at Kiva is to really try to raise awareness about this opportunity that anyone in this room could connect with an entrepreneur in, whether that's Detroit, Philadelphia, or all the way in Manila. You know, that's really powerful. That's the barrier to entry, a $25 loan. And you're getting that money back minus default. So for us, that's really, I think, where we're placing a lot of effort. Much of my role at Kiva is really focused on how do we generate more loan volume? How do we get more people to understand that there's this amazing opportunity for them to have this meaningful connection with a borrower? And when you think about it, your $25, there's no fee. So we have this relationship with PayPal that there's absolutely no variable costs when you're making your donation, your loan, and you're also, if you want to withdraw that loan from your Kiva account. So when you actually make your $25, you put it into the hands of a working entrepreneur somewhere else in the world, that money gets repaid back to your Kiva account. More than 90% of Kiva lenders choose to recycle it to a new entrepreneur because they never really perceived that $25 as a loan that they wanted to take back. They looked at it as sort of like an overperforming donation as opposed to an underperforming investment. So Kiva lenders are truly, what's so powerful about this model is the recycling effect.
So criticize yourself, and tell me what's the downside. What should I worry about? I hear the good, and that's very much upfront.
Glad she asked you that question, not me.
I'm coming to you, Mark.
Shoot.
What's the downside?
Yeah, like I'm taking a public interest view. We heard, going back to the mortgage situation, where there were these loans that broadened the market, got people who couldn't afford homes into it, but there was a downside to that whole subprime process that ended up in really not a good spot for the collective whole. What about Kiva? And I don't mean Kiva per se, but this type of a solution, because there are other competitors out there. What might be elements for us to think about as being a downside or going too far or mismanaging if we don't do it right?
Yeah, there are microfinance institutions that are in the developing world, in areas here in the U.S. that are really driven by profit. And they're looking at it purely from an economics model. They want to see how much can they reap from this particular demographic. And that's happening around the world. And I think that is a part of microfinance that we at Kiva are very careful. We have a large portion of our staff that is focused purely on just ensuring that we're partnering with the right institutions that are delivering impact to the most marginalized communities. So we do work hard to ensure that we are reaching disenfranchised and financially excluded populations through the right partners. But it's certainly an issue in microfinance. I think you've heard about predatory lending, you hear about over-indebtedness in the developing world particularly, and those are real issues with the field.
So Mark, you've been around this block a few times. Maybe, or is it that not your first rodeo, whichever the expression is? Yes.
Definitely not. I did one rodeo. I fell off. It was no good.
So step back and tell us what you think about, what's your experience, sort of comment on this.
My experience on all of this, or
well, let's start off with the microfinance, because you made a passionate statement about that.
Well, about small business, not just about microfinance. Yeah.
Exactly, small business. But think about what is the unintended or the unanticipated that this could take us to, that you might see, and what about the winners and the losers in all of this shifting of those boundaries you talked about?
Yeah. So I just want to say, I've been to the Kiva offices. It's a remarkable place, and what you're not talking about that's the most to me, the borrowers you can only see on the site, but they're remarkable and they're incredible, and the people who donate who you don't see. But I happened to be there the day you had, I forget what they're called, your fellows, is that what they're called? The folks come in from all over the world. There are volunteers all over the world who are a huge contributors, more than $25 that they contribute because they're self-funded.
4 months.
For
4 months in the field.
It is unbelievable. It's part of sort of the economics of it. And that mobilization to me is every bit as astonishing as anything I've ever seen. It's really a remarkable part. People need to understand that because it's a movement and it's generated that in some way. And I agree with you that it's sort of a mission risk is the danger. And I don't think you have that problem with those folks. But in this country, it is an issue. And so I would actually go to the same sort of thing in small business in this space, which is, and for CDFIs as well, is that in general, CDFIs in this country right now are trusted enough and popular enough that we have too many opportunities, and there are too many people coming to us with propositions and ideas of things we can do, and the potential to make mistakes that are mission drift mistakes that are going to get us lending to the wrong folks or get us involved in some way in the wrong way. We've grown beyond the ability where we have sort of the internal controls in some, or I worry that we do in some ways, and so I worry about that a lot. And just to go back to I just want to play out a little bit earlier the thing I was passionate about, which are some unscrupulous lenders, some of whom are online, some of whom aren't, some of whom are working through brokers. So people understand this is routinely 80, 90, 100, 110, 120, 130, 150% loans, right, that are going to small businesses deceptively. So the borrowers don't know that that's what they're getting. It's not as good as 0%. And this is going all over the place. And I worry a lot about people in my business also getting sort of sucked into that vortex.
So this is the time when all of you get to come up with your questions. There are 2 sets of microphones, and we already have one, so please give your name and your organization and your question briefly.
Thank you. I'm Lynn Martin Haskin with the Philadelphia Association of CDCs, and I have 2 quick questions for Steve. First, if you said this, I didn't hear it. Are there other infrastructure trusts in the country? And secondly, have there been any political sort of disses or negative editorials or snipes or complaints or aggravation that you've gotten doing what you do, which sounds terrific?
Sure. First, there is no other organization quite like the Trust, particularly because we're a private company. There is a West Coast Infrastructure Exchange. They're not really doing projects directly the way we do, but it's a consortium between British Columbia, Oregon, Washington, and California. And they are going to be some sort of clearinghouse. And they're still working out quite how they're going to operate. There are 3 states or a commonwealth in the United States in particular that do this well. None of them are private companies. They're all government agencies. That's in the Department of Transportation in the state of Virginia, the Department of Transportation in the state of Texas, and the Commonwealth of Puerto Rico. So they seem to have a good handle on doing it. They've done a number of projects. Those projects seem to be going okay. So those are the 3 places. Canada, the United Kingdom, and Australia are the English-speaking countries that do this pretty well. It's kind of an interesting point that I've been learning. The United States is kind of a third world country when it comes to private financing of infrastructure. And what we call third world countries are often first world countries when it comes to the private financing of infrastructure, because they don't have public finance markets. So those countries have always had to rely on private financing for their infrastructure. And I've been told by some of the largest pensions in the world, which are not in this country, that they would rather invest in Nigeria than in Chicago in some cases. And when they said Chicago, it was because I was sitting there. They meant the United States in general. But because there was less political risk, and they were naming countries that I thought had a lot of political risk, so, but they meant it on a financial level. So, so we have a lot to learn in terms of private financing of infrastructure in the United States. In terms of your second question, the answer is kind of yes to everything. So there's a lot of people that the existence of the trust gives particular angst to them. There was a massive amount of publicity before I arrived at the trust for the trust. That was probably a little bit of a mistake. It mystifies me because I think I'm doing procurement and finance, which doesn't sound particularly interesting. But nonetheless, there's been a lot of interest. There is a lot of angst, again, around the idea of sort of people benefiting privately from public assets. And as a result, the mayor, the bureaucracy of the city, myself, the bureaucracy of the trust, such as it is, we have shied away from doing what people call P3 or public-private partnership deals that involve substantial cash inflows, particularly equity inflows that are very expensive and that result in some sort of private ownership or lease for an extended period of time. So in the case of the city of Chicago, parking meters is always thrown out as an example because there was a deal done there for the parking meters that was a suboptimal deal that was not done well from a transactional standpoint. So, and it gets people upset. So, and there is a good reason to be upset when you sell an interest in your parking meters. You actually are selling an interest in the control of your streets. And you have to be able to control your streets if you're managing a city, particularly a major metropolitan area. And so, for example, people are contemplating doing bus rapid transit in Chicago. In order to do that, we actually have to engage in a transaction to sort of, if you will, buy back parking spaces in areas where that parking is now being run by a private company. So, which doesn't necessarily make the bus rapid transit project economic. So you have to be extremely careful about how you exercise control of your geography while you're doing these kind of projects. And hence, there's learning, and hence there's angst, and there's criticism in the press. So I encounter all of that all the time. But we also get some nice press as well because we're trying, and they're beginning to see that we're not planning to sell the city out from underneath the public. So, so that's about where we are.
I would trust Steve when he spoke to me about a project, right? Totally. So I'm going to ask both of you to put out your questions to make sure we get all questions out. Please.
Thank you. I'm Walter Wright from the Cleveland Foundation. And first of all, I'm a huge Kiva fan, especially Kiva Zip, and have participated. But to me, it's a bit of an arm's length online virtual experience, which I think is great, but it's kind of like Facebook. I love Facebook, but I sometimes want to step away from the computer and interact with actual people. So I'm interested in how we can use money to build community. And I used to work in a neighborhood and do some commercial support, and I found that most of the people who started businesses there financed it either through friends and family or credit cards. And I was interested in, well, how can you get people in the community to participate in financing small business? And what I found is that you really can't. I didn't know what a qualified investor versus a non-qualified investor was and the SEC regulations, but I did a lot of research. And what I am interested in is finding ways to allow people to participate directly with small businesses. So I'm looking at doing something in Cleveland which would allow investors, small investors, non-qualified people who are not millionaires, to invest in small businesses. And it would be a below market loan, short term, relatively small, and exercised via promissory note and exercised via relationship with that business, much like Kiva does, having somebody vouch for that person.
So your question is?
So I'm wondering if anybody has any experience with that type of direct, participatory, community-based loan.
Okay, great. And let me hear your question.
Great. So I have a couple of quick questions that perhaps just the folks up there can clarify. Dave Zuckerman, I'm with the Democracy Collaborative. So regarding Kiva, I was curious the demographics of those who are the lenders in general. Mostly I'm curious about the age of those who are the lenders, and also whether this has been connected with local financial institutions, so as someone builds creditworthiness, that they can then move out of that system. And I guess I would say, though, the one potential drawback of that is you have a lot of folks who not crowdsource, but provide these zero-interest loans in a donation type way, and then it moves into the mainstream financial system where the financial system gets the interest over the long term. So I think that's perhaps one downside, that the masses don't really get the long-term benefit from interest. It's the financial institutions in the long term. And then my last question for the trust was, what is the average ROI for an investor in the trust in terms of the private capital that's put in?
So hold those thoughts. I know I'm building the startup. Is there one more? Yeah, please come on up and let's get yours on it too.
Hi, I'm Sarah from American Banker. I actually have a related question, which is, how do you see your financing models, sorry, is this better? How do you think your financing models may change the way that more traditional financial institutions operate, and have you seen those changes already taking effect?
You mean upstreaming?
Yeah. If you're seeing more traditional banks and other kinds of lenders changing their approach to lending in response to these more innovative.
We have a question on the trust. We have some questions for Kiva, and I think you can
I'll talk anyway.
You'll talk anyway. Good. All right, Steve, you're on first.
The return on financing that right now we're averaging is about 5%.
I know we stand between them and their dinner and their drinks, so go ahead, briefly, yes.
Cleveland, Ohio. Where's our Cleveland friend? There you are. I would say one really easy step, if you wanted to get involved and support economic empowerment in your community, consider becoming a trustee. So you saw the Mission Economic Development Agency as an institution, but you can actually be a person and vouch for somebody in your community and say, I think this person is good for their loan. I believe they'll repay back their loan. Now, in terms of how you can engage institutions to get involved with this lending, you could set up a matching loan fund. Let's say in Columbus you have a number of entrepreneurs who are crowdfunding loans on the Kiva platform, and for every loan that's made by the crowd, the Kiva lender, like here comes $25 from somebody in Taiwan, it's going right to Columbus, Ohio, your group of below market investors could consider setting up a matching loan fund. Well, they'll match that $25 one-to-one. And that gets repaid back to your group of investors at about 90%, because that's really what the repayment rate right now is for Kiva's US program. And then, go ahead.
No, go ahead.
And I think the other question was about our lender demographic. So we have, for our US program right now, there are 38 countries represented on our lender demographic. Last month, we launched Kiva Pittsburgh. And there's a woman there who runs an ice cream shop. And she got her very first loan crowdfunded on Kiva from somebody in Pittsburgh. She got her second loan from somebody in Taiwan. And she started crying because somebody who she never met on the other side of the world believed in her ice cream shop. So you've got lenders now who are crowdfunding Oakland entrepreneurs from Kenya. So we're starting to see the reverse money flow. Yeah, capital is now moving in directions that I don't think anyone really anticipated. So the typical lender for Kiva is really changing, and it's hard to say, but it's been traditionally a lot of women between 18, it's a pretty wide range, it's like 18 to 50, 55.
Do you track ages?
We do track, well, it's all self-reported.
Yeah.
Yeah.
I was 18 for a long time.
Especially online, right?
Totally online. So I'm going to let you answer, but I'd also like to do a takeaway for the audience, so you'll get
I'll do
answer.
2 for 1. I'll
You'll do
answer
2 for
and,
1.
and then
Yes,
I'll do
exactly.
a takeaway. And I think the question about that, if I understood the question about, is this changing the behavior, maybe it isn't, but I'll answer it anyway. Is this changing the behavior of other lenders, more mainstream lenders? I think that was sort of the question.
Yeah.
And I would say that in some way, that's, from my perspective, that's what this is all about. Yeah. This is really about changing. I sometimes call CDFIs tugboat lenders because we're trying to use a little bit of leverage to change the direction of the big luxury boats,
Yep.
right, in
Yep.
some way. And so if we can change their behavior, that's a good thing. When we did, some years ago, we did a partnership with Starbucks called Create Jobs for USA, and produced about $100 million of lending for small businesses around the country, which is good and nice and all that. But the point was, and it's good for the businesses certainly, but the point was really at sort of near the low point of the recession, was to demonstrate that there were businesses out there that were creditworthy, that we could lend to them, that they would pay us back, that would create and retain jobs. And so it was as much about proving the point as it was about anything else. Right. And then the takeaway comes from the question from Cleveland. I was just in Cleveland 2 weeks ago. I didn't see you there, but it was good to be there. And it is that ultimately, I think the way you do that, and Kiva's found one really interesting way of doing it, you're another interesting way of doing about it, and this goes back to my original point, ultimately it's about some innovation and intermediation, right? It's really about who's that intermediary, and maybe it's a reputational intermediary or a, what do you call them, an endorser? Trustee, who's sort of in effect endorsing someone, so maybe there's a social intermediary in a sense. Maybe it's a financial intermediary that makes it possible for the city to move in a way that it couldn't otherwise and to get things done that it couldn't otherwise. And entrepreneurial folks who see pools to be fixed to do things otherwise. But I think as I listen to this, partly because it's where I started out and it's what I wanted to hear. But I think that what's really interesting is you found a really interesting way to intermediate with a great agility in the city of Chicago to get things done that were otherwise may have gotten done, but they were hard to get done. And you found through technology a way to bring people together and transact. The coolest thing about Kiva when you're in the office, well, one of the cool things about Kiva is you get to see the actual transactions happen, right? You can see the map where you see money going from here to there, right?
Cool.
But it's really it's a way of making sort of the intermediation visible in some way. And I think that's incredibly important to people. And so I still think that the innovation in all of this, there's a lot of wealth out there that can be, and people manage wealth that are really innovative. And in my world, low-income and low-wealth people are the most innovative people I've ever come across by far. And bringing them together is the challenge. And so figuring out how to intermediate that is key. That's my takeaway.
Great. How about you, Steve?
So on a more narrow basis, the trust is essentially enabling the city of Chicago to deliver more infrastructure to its citizens at essentially no cost to its citizens, so stretching its resources to enable it to use those resources for other activities that you wouldn't normally have an alternative in terms of from a financing perspective.
Something from nothing, or something extra.
Not free,
No.
not free.
But less, yes. Wouldn't happen. How about you?
I think my takeaway is that there's your point, and people want to engage, and I think that they haven't been able to very easily find a way where they can actually get a feedback loop and see that it's not a donation that sort of disappears off into who knows where, but you actually get that money back from the entrepreneur. You get email updates. This is such a low barrier to entry to have huge, meaningful impact. So for all of you, if you haven't made a loan on Kiva yet, please do. And if you're interested in trying to bring it to your community and to your cities, we're launching a Kiva Philadelphia with Mayor Nutter's office, and sometime this year in 2014. There's a huge potential for Kiva to have impact right here in the U.S. So think about that and think about maybe possibly playing the role of a trustee and endorsing a local entrepreneur and getting the both of you up on the Kiva platform, crowdfunding a 0% loan.
It makes the world understandable in some sense.
It really
Connection.
human skills it.
Yeah, exactly. Well, I'd like all of you to join in with me to thank our expert panelists. So this panel discussion closes out the activities for today. We'll see you all tomorrow at the Crystal Ball session that starts at 8:30. And I want to thank you all for attending. and have a wonderful evening enjoying yourselves. Good night.